That's it, guys. I'm over this. I'm over the CCIV BS. I quit this game. How many of you guys are ready to throw in the towel? The markets are melting away and there's no exit in sight. Let's go over some CCIV price targets, short interest, and institutional holdings. Instead of going over any new news on CCIV, I will go over some protective strategies to implement to any of your losing positions. I will go over some tail hedging strategies I implement with options. If you are seeing your portfolio melt away and want to do something about it without selling your positions, you don't want to miss this video. And no, I don't quit, and I haven't sold my shares. I actually added to my position. I was just joking about quitting. Don't lose focus. Use the strategies I will go over in this video to preserve your capital. Make sure you click the like button, subscribe to the channel, and click the notification bell to join our Options Temple community. And as always, timing is everything. Get notified so that you don't miss an opportunity. If you're new to investing or upset with your current trading platform, try Webull. Get 2 free stocks with Webull if you deposit $100 or more. Click on the Webull link under the description below. So what is going on with CCIV? Why is it selling off? There's not a direct catalyst that is causing CCIV to sell off. The market in general is selling off and we are getting close to a 10% market correction. The 10-year bond yield is rising. This is causing market worries. If we take a look at TLT, which is a 20-year bond ETF, it is selling off at an alarming rate. It's currently at $138.95. During last year's March market lows, TLT hit a low of $139.01. We are lower than the pandemic lows. This is extremely bearish for markets. I don't want to get into macroeconomics in this video. That's a whole other video on its own. TLT selling off is an indicator of markets selling off. The bond yields are rising due to the inflation we are going to encounter in the near future from all this free Fed money. I personally don't think this is the big crash everyone is talking about, but I do think we'll see one sometime this year. If we take a look at the volatility index, VIX, this is an instrument that measures market volatility. The higher this rises, the lower the markets go. The VIX is currently at 2670. Just to compare against the pandemic March lows, the VIX hit a high of 8550. We still have a long way to go. This is one index to watch for on a daily basis to get an idea where markets stand from a volatility perspective. CCIV today got destroyed once again, and there's no telling where it ends. It plowed down my $2650 buying price target. It closed at $24.20, and this is an optimal time to size up and buy up CCIV. With that being said, I'm sure, like myself, we are probably already all in. The last price target I have plotted is at the 2050. If we break below 2050, that will alarm a long bearish cycle for CCIV, in which it might take a while to get out of, and markets will probably be up in flames. Before I go over my tail hedging strategy, let's take a look at the institutional holdings and short interest. The institutional holdings are unchanged at 153. No one is selling or buying. They are all just holding. The last buying we saw was from Monday, March 1st. The short interest is slightly rising, but nothing to be alarmed about. The short volume ratio is at 19%. Although it's a little late now to tail hedge, you can still protect your portfolio if you think we go lower. This is an Options Temple exclusive strategy, and I am sharing what I've learned in the past few years of trading. A simple way to hedge your portfolio is by buying calls on inverse ETFs like the VIX or VXX. I like to buy calls every month, buying 2 months out in order for the position to overlap month over month. Consider this money gone. 8 or 9 times out of 10, you will lose that money. It's insurance. This is something I've been doing during these elevated volatile levels. I try to buy 1 call option for every 100 shares I own of any given stock. I sometimes only buy 1 call option for every 200 shares I own of any given stock to minimize my allocated buying power. I will buy something around the 40 delta with around 45 days out. For example, if I wanted to buy something tomorrow and I own 1,000 shares across my total portfolio, I would look at VXX. VXX closed at 1561. Let's take a look at the options. I would go out somewhere close to 45 days out. In this case, I would look at April 16. That's 44 days out. Let's go to a 40 delta. That puts us at around the 19th strike. These are going for roughly about $1.58. I would buy 5 of these to cover half of my 1,000 shares. That would be a total cost of $790. Now, if this is too expensive, you can go with something like a 30 or 25 delta. That's like the 22 and the 25 strike. That would reduce your cost basis and would only work out on a massive move. You can also do this on the VIX or any inverse ETF. You continue to buy month over month for as long as you think it's needed, and I don't sell these until expiration. Consider this money gone, but it can save you in a black swan event. If you're extremely bearish, you can buy 10 contracts to cover your 1,000 shares. You can also buy more than 10 contracts, but at this point, you are just speculating. Just keep in mind, only use this strategy when markets are bullish. For our current bearish conditions, I would buy short-dated options, about 2 weeks out. Feel free to make your own variation of this strategy, but in a nutshell, this is how I protect my positions. Another strategy I recommend more than buying call options on a volatility or inverse ETF is buying protective puts against your positions. This is more direct and better performing way to protect your portfolio. It just takes a little more work. I prefer this strategy over the first strategy I just mentioned. It's a similar setup. Let's use CCIV for example. CCIV closed at 24.20. Since CCIV already had a significant drop, and if you would like to buy protective puts, I would buy less time, like 2 weeks out. When CCIV was on a bullish rally, I would recommend it 45 days out. At this point, 2 weeks will do to preserve capital. Let's assume you have 1,000 shares of CCIV. You can buy either 5 or 10 put contracts 2 weeks out, depending how bearish you are feeling. If I was doing this position tomorrow, assuming CCIV opened at 24.20, I would go with the March 12th or 19th. Either or will do. In this example, I'm going with the March 12th, 9 days out options. The delta is currently not showing right now during after hours, but since CCIV had a big drop, I would buy something closer to in the money. I would go with the 22.50 just to be safe. I would buy 5 or 10 if you're extremely bullish. These are going roughly for $1.20. The exit strategy is to leave them on until expiration unless you're a sharp trader and you think you can time the market. I'm personally a pretty sloppy trader and wouldn't try timing these. The purpose of the strategy is to protect your shares and not speculate. I would much rather have the stock rise and make money on my shares and having these positions expire worthless. Let's assume the stock rallies to 30 by the end of next week. At that point, I would buy 30 to 45 day out of the money protective puts and rinse repeat the process every month. Use these metrics as a rule of thumb. Every situation is subjective to the market sentiment of that time. This is a strategy I've tested across different situations and worked the best for me. Doesn't mean it will be true to you based on your risk tolerance and trading style. I hope this video gave you some peace of mind going forward. I'm not giving up on CCIV and I don't care what the price does in the short term. In the long term, I know the potential of this stock. Also consider the merger date as a short-term catalyst. We will see the stock have a nice rally before the summer. I just opened my new store. If you would like to support this channel, take a look and pick up a t-shirt. Click on the link under the description to go to my store. That's pretty much it for this video. If you liked this video or found this information useful, click the like button, subscribe to the channel, and click the notification bell to see more trading and investing ideas. I'm not a financial advisor and this is for entertainment purposes only. And as always, timing is everything. Get notified so that you don't miss an opportunity.